Hi friends, Simit here from InformedTrades.com. In today's video, we're going to talk about the credit rating agencies, what they are, how they work, and how bond investors can use this information, use these ratings to make investment decisions. Let's get started. Okay, key points. The three big credit rating agencies are Moody's, S&P, and the Fitch Group. They rate credit instruments based on their default risk. So we'll talk about what that is. Their ratings determine whether a bond is investment grade or high yield, so the risk level of the bond. We'll talk about criticisms of the rating agencies, as well as some sample usage of how this information can all be applied using a bond screener. Okay, the big three agencies, Moody's, S&P, and Fitch Ratings. Really, Moody's and S&P are the two really big ones that have 40% of the market share each. Fitch Ratings has 15% market share, and it's mainly a tiebreaker between Moody's and S&P. So collectively, these three agencies have 95% market share of the market for credit ratings, of rating any credit instrument. So really, it's an oligopoly. They have a lot of control, tight control. Just three companies, and really Moody's and S&P are the two big players. So you could almost argue it's a duopoly. Rating agencies, what do? They assign default risk. So basically, you make a loan when you buy a bond or any variety of credit instruments out there. We've mainly been talking about bonds. It's a loan, and there's an expectation that the bond holder, or the company or a government issuing the bond, is going to pay you back. So default risk is an assessment of the entity's inability to pay you back. Do they have enough cash? Are they going to have enough cash in the future? Do they have so much debt that they already have so many debt payments due and cannot take on more debt? What's the risk of the industry they're in, if it's a corporation, or the government, if there's a currency risk? Those types of things. All those factors, that's what the rating agencies focus on. So that's how bondholders use them to identify what's the default risk that the company is not going to be able to pay me back, that I'm going to lose the principal, or a government, conversely, is going to do that. And factors into that the currency risk, if the currency is going to lose a lot of value as well. So interpreting ratings, on the screen right now you see sort of a matrix of how the three agencies make ratings, and sort of a description of what those metrics mean, or what those rating symbols mean. Basically, the main thing you want to look for is this red line here. Above this red line equals investment grade, you can see on the right, and below this bond equals non-investment grade, also known as high yield or junk bonds. So as a general rule of thumb, the lower the ratings, the higher the yield, but it's also greater risk. So these companies will tend to, and governments will tend to pay more in coupon payments, higher yield, but there's a greater risk that they're just going to go bankrupt and not be able to pay you back. Investment grade, the risk is lower, and of course, as you get higher, the risk gets lower and lower, but the yield, conversely, gets lower as well. So triple B minus, or Moody's is Baa3. That's sort of the idea for a long-term bond, the minimum that it will be considered investment grade. And of course, depending on your risk sensitivity, you may want higher and higher bonds, and you take lower and lower yields for that, or you may want to spread it out across the risk spectrum. Criticisms. Okay, so the rating agencies have been criticized quite a bit extensively. They've been sued by the U.S. government. S&P, you can see the headline there, sued for $5 billion. There's been class action lawsuits against credit rating agencies. They didn't foresee 2008. They said everything was fine, so it was the biggest credit crisis in modern history in quite some time. Who knows going how far back since we've had a bigger credit crisis, possibly never. And they didn't see it at all. They acted like everything was awesome and great. One big part of the criticism is that the companies that they rate are the ones paying them. So, there is obviously a conflict of interest there where a company is paying them to issue a rating, and they go ahead and issue a good rating in order to continue getting that company's business, whether or not that good rating is warranted. So they're not really objective. Their customers are the people that they're rating. That's a big criticism of them and a conflict of interest. Now, with that being said, their ratings do impact the market. So whether that's legitimate, whether ratings are complete nonsense, either way, when they downgrade a company's credit rating, you'll see it impacted in the bond price and perhaps even the stock price. And same interest, same idea when it goes to government bonds and all the other credit instruments that they rate. So their influence is pretty significant. On the screen right now, you see a bond screener that comes from Yahoo Finance. As I mentioned, I don't think this is a great screener, but it is one of the few bond screeners that is available for free on the web, or even, I haven't even seen good premium screeners out there. I've seen screeners associated with brokerage accounts, and I don't even think those are very good. So if you actually, and I've mentioned this before, if you do know of a bond screener that you think is pretty cool, share it with us at Informed Trades. Would definitely love to check it out. Okay, but here you can see Yahoo only allows for Fitch Ratings, or only allows for screening by Fitch Ratings. As we discussed earlier, that's one of the smaller ratings agencies. S&P and Moody's are the two big ones. Fitch has 15% market share, is mainly a tiebreaker when S&P and Moody's conflict. But anyway, here if I set the Fitch Ratings range to BBB, which is the lowest, actually BBB minus is still investment grade, but they don't give me that option here. BBB is the lowest I can select and still be investment grade bond, which is less of a likelihood of a default. Find bonds, that's pretty simple. So you can see the price, you can see yield to maturity. Here's the Fitch Ratings. If I were to sort by yield to maturity, let's see the highest. We see there's a number of bonds, Societe Generale, Bank of America, pretty high yields here, 15% up, almost 20% on this S&G structured prods. So that's the basic idea. You can sort of incorporate the ratings to see if how likely a bond is to default according to these agencies, and incorporate that information into your bond investing. Any questions you have, anything you want to add, join us at informedtrades.com. If you'd like to support us and help us make better videos, contribute. Any contributions would be greatly appreciated. informedtrades.com/donate. And of course, if you like this video on YouTube, share it on Facebook, Google+. That will be greatly appreciated as well. Best of luck in your trading and investing, and we'll see you next time. Take care.